And into the summer, we've had a nice little rise. Look at this right here. This goes against the grain typically.
Welcome to Gold Silver Pros.
Hey everybody, this is your host, 𝘬𝙁𝙊𝙍𝙁 of 𝘬𝙁_pros.com. I'm broadcasting on Monday, September 11th, 2023. First of all, a moment to remember what happened at September 11th, all those years back, and thinking about the families that were involved in that tragic event. Our hearts and prayer go out to all of those families involved and all of those people that were involved in that event, including all of the emergency workers that were involved. I know this is an anniversary of that, and wanted to be cognizant of that as we hit September 11th once again. Again, appreciate everything that was done there on that tragic day in American history. All right, we're going to get straight into the news, ladies and gentlemen, because we had a lot going on. So I'm going to start off with the economic calendar and tell you guys what's been going on in the last week. The last week was kind of light on economic data, so we're just going to give you the ones that matter. Factory orders across the U.S. were down about 4.5% from a print of 2.3% last month to negative 2.1% this month. The U.S. trade deficit was about even. It was $65 billion. That's in the normal range. It was 63.7 last month, meaning we increased overall net our purchases over what people bought from us. Not a big change. The U.S. Services PMI, the Purchasing Manager Index, an indication of where services may be going in the future, or services industry, which is the largest part of our economy, fell from a print of 51 to 50.5 this month, basically a sideways move, although the services index put out by ISM actually rose from 52.7% to 54.5%. So services about even. Initial jobless claims fell from 229,216. Not that I actually believe that number, but I'm going to read it out anyway. U.S. productivity fell from 3.7 to 3.5%, and wholesale inventories rose from a negative 0.5 to a negative 0.2. Not a lot in the actual economic data, as I said. It's a slow week in the month. The second week of the month usually is. We don't get a lot there. We're going to give you a little bit of what's going on in the market. NASDAQ popped about 1% today so far, up 156 bucks. The S&P is up $30. The Dow Jones is up 87 bucks, and the Russell 2K is up 2.84. So overall, the stock markets are doing okay. The bond market, I'm not going to spend a lot of time on this, is basically sideways. The 2-year is at 4.988, once again approaching 5%, which I think is a critical level for that. The benchmark 10-year is at 4.29. All you got to know is every bond issuance shorter term than 10-year is a higher rate than the 10-year, which means that's predicting a recession. And it's been that way now for months. It's not going away. And that indicates a recession is right around the corner, because that has been the single biggest predictor of a recession every single time it happens. And it's happened before each of the last several major recessions. Going on to cryptos real quick, Bitcoin continues to take it on the chin, down to 25,069 today, down $650 as we speak. Overall, Ethereum is also down $67.66 to 1543. Litecoin's down a couple of bucks to 58.27. XRP is relatively unchangeable, down 3 cents to 47. Almost back down to where it was before the settlement with the SEC was announced. And there you go for the markets. Not a lot going on, but there's a couple of big stories, and we're going to start with inflation. The 1, 3, and 5-year inflation expectations of the public is rising for the first time in the New York Fed survey. It finds a deterioration in household financial sentiment as long-term inflation is seen to rise to a 15-month high. The 5-year inflation expectation of consumers rose the most, and this is on the heels of the CPI print, the last one we had, where it rose from 3.1 to 3.2. This is the first rise in both expectations of households of inflation and inflation itself in some months. And remember what I said, the deflationary effects that we saw dating back to late last year through summer of this year would likely turn north again sometime this year, because it was a short-term deflation. It was in reaction to the tightening by the Fed. It now seems as though the economy wants to inflate again, regardless of the Fed position. It'll be interesting to see what the Fed does as a result of that. The other big story of the day is that the House committee will reopen discussions on the digital dollar September 14th. That's 3 days from now. This week, the House committee is going to start talking about the central bank digital currency here in the United States. The article from Cointelegraph says, following an August recess, members of the House Financial Services Committee will gather for a digital dollar dilemma, in quotes, hearing on September 14th. Says the United States House Financial Services Subcommittee on Digital Assets, Financial Technology, and Inclusion will be holding a hearing discussing central bank digital currencies for the first time in months. In a September 7th announcement, Republican lawmakers on the committee said they plan to hold a hearing discussing the implications of releasing a CBDC as well as private sector alternatives. The digital dollar dilemma discussion will be held on September 14th, roughly 2 weeks before the U.S. Securities and Exchange Commission Chair Gary Gensler will reportedly testify before the full committee. Chairman Patrick Mahenry announces hearing on the Subcommittee on Financial Institution and Monetary Policy and Digital Assets, Financial Technology Inclusion on Twitter on September 7th. The hearing will mark the first time in months lawmakers and the House committee will address issues related to the rollout of a digital dollar in the United States. Members of Congress were largely in recess for August. A potential CBDC rollout in the U.S. has become a policy position for a few presidential candidates running in 2024 for the presidential election. Florida Governor Ron DeSantis, the leading Republican Party candidate behind former U.S. President Donald Trump, said in July he planned to ban CBDCs if elected. Vivek Ramaswamy, another Republican candidate trailing behind DeSantis, has also criticized CBDCs, comparing the technology to China's social credit system. Some U.S. lawmakers have proposed different legislative approaches to tackling issues related to the CBDC rollout in the country, the article continues, including limiting the Federal Reserve's authority over issuing a digital dollar. Various U.S. states have also passed bills banning CBDCs as payment options, including Florida. So there you go. It looks like a lot of presidential candidates are worried about digital dollar. It looks like the House committee is going to meet. Several states have passed laws against them, but that's not stopping what is likely to become the onslaught of central bank digital currencies known as a digital dollar here in the United States. That's huge news for those people that thought that we would never get a CBDC or a digital dollar here. I got news to tell you. We're probably going to get one, and they're meeting on how it's going to go down now. All right, getting into the presentation portion of it, where we get into the precious metals markets. Here on the screen, you can see the gold futures, and we're going to go over that. This is as of Friday, September 8th, as you can see right here. Looking at volume, it's gone up a little bit in early September, not a lot. We don't have a lot of deliveries in September. There's only 810 contracts open as of Friday. Of course, that'll change today, and we'll get that data later today. Only 6 deliveries. This is not a big delivery month. The next big delivery month is more than likely a little bit in October, because look, you have 25,000 contracts there. You could have maybe 1,000 or 2 deliveries off of that if people really want it for October, and I expect to see some healthy deliveries. But the really big month is going to be December. Why? Because this number right here, 374,000 contracts on the December contract. December is always a big delivery month in gold and silver because it's the last one of the year, and both gold and silver trade heavily in the December contract. So they typically have higher than normal deliveries. We're going to see it. But you see some of that trade starting to roll to February. So February will be the next big month after December, but December is where all eyes are on it. So as of Friday, we had 138,694 contracts trading, as I've got highlighted right here in the middle. That's mostly paper trades because, again, only 6 deliveries. But we saw a healthy, about a percentage of that, go in exchange for physical over to the UK OTC market, the London OTC market. The OTC is an unallocated market in which you may or may not actually get the physical, but at least you can play the price differences. And we've been seeing continued interest in gold and silver in that market, where you can't get it delivered here in the U.S. That means physical demand is higher than the current delivery numbers, mostly because you don't have big physical delivery months until December. So people are taking it overseas to look at it. Now, on Thursday's data, as you can see, we had 1,293 contracts go over. And on Wednesday's data, we had 857. So a lot of demand moving over to London. We're going to go over to settlements data, as I always do, and just tell you what's happening. The reason I do this is to prove that the COMEX really does a lot in setting the actual spot price of gold and silver, because it pretty closely matches what the spot price is. People will tell you it's a multi-market determination, but those markets almost move in unison between the US and the UK with some price differences there. As of Monday, we get some Monday midday data, 1:32 p.m. We're looking at gold being up on the December contract about 450, about 490 in September, which makes sense. It means gold is not really in a backwardation state, and that's Monday's data. Going back to Friday, where we got a full day's data, it was up on the December contract about 20 cents. And on Thursday, it was down about $1.70. So we're range trading, which I'll show you what that means here in a moment. Let's go over to the silver chart first. Here's the silver information on the COMEX. You can see on the volume and OI charts, more interest in silver overall, which makes sense as an industrial metal. So even during the summer when people aren't trading gold, they'll trade more silver because you get more hedging going on in that market from the producers and the traders. Right now, September had 100 deliveries, which is notable because there's only 177 contracts left. Of course, the big month is December. As you can see, all the numbers are bigger in this row. 52,000 contracts as of Friday's data had traded. 1,021 of those went over to London in search of physical silver, and overall 112,000 still open interest in December there. The next big month looks to be March, which is normal for the silver market. Going back to Thursday's data, we had 50,000 contracts trade. We had 536 EFPs and only 49 deliveries. Let's go look at the pricing data as we always do on the program. And again, I do this over and over so that you understand how the market works. And by looking at this many times over time, you'll start to see patterns. And that's my goal here, is to get you to start to see patterns and how this market's traded and why. This will help you make your decisions on when and how much you're buying of your gold and silver, because when the patterns emerge, you go, oh, I noticed this pattern. Oh, what does that mean? And these are valuable insights for you. Okay, now in silver, again, we have half a day of Monday's data on the actual price change. So far, we're trading up almost 21 cents on the day, 20.9 on 23,383 settled contracts through about lunchtime, 1:30 p.m. Central Time. And if we go to Friday's data, full day data, it was down about 6 to 7 cents on healthy trading of 23,000 contracts. And if we go to Thursday, it was down another 26 cents on, again, another 23,000 contracts. So again, silver is range trading also. Let's take a deeper dive at the Comex Gold chart. You can see we've got a flag pattern forming here, or a consolidation pattern where it goes like this. Usually is where we'll start to get some sort of breakout. I don't think this flag is quite finished consolidating, but what happens is the traders trade in a tighter and tighter and tighter range, and it'll frustrate the heck out of traders and people that buy gold and silver because they want it to go up or they want it to go down. They want it to go a direction, and it's been consolidating here since about the April-March timeframe into a tighter and tighter band. Usually it will break out at some point in time after that. So either we're going to get a big upside breakout or a big downside breakout. I'm betting upside because of the economic data that I've been reporting on for months and months, actually years, but months and months this year, which is turning now negative. And I've highlighted the fact here, you've got two squiggly lines. The red one is the shorter, the 50-day. The blue is the 200-day. This is the red and this is the blue. We're sitting above the 200-day, which means we're not really in a bear market because it's above the last 200 days trading, which is slightly positive, but gold is slightly below the 50-day and re-challenging it. So again, that's the ultimate consolidation pattern when you're above 200-day, below 50-day, and you've got that wedge pattern forming or that flag pattern forming where it's really tightening up. All right, now going on to the gold. I wanted to take a look at the delivery chart for gold. You can see in September only 6 deliveries, but you see in December a lot of volume. That basically is just pointing out that most of what you see in setting the gold price in silver too has nothing to do with physical deliveries, especially in off months like September and October usually are. Until December, you're not going to have a ton of deliveries, and then the deliveries may have more of a correlation with the price, but right now there just isn't, and that's why I did that chart. The fourth chart we have here is looking at silver in more detail. Again, we've got this flag or this consolidation pattern forming. Silver is actually below its 200-day. It's a little bit of a bear market, a little mini bear market, not much, because gold's not, and usually silver will follow gold. Sometimes it's more volatile. It's, the little brother, if you will, that kind of acts up a little bit more, and so you kind of have to discipline it. So silver is a little bit below its 200 and 50-day moving average, and it's testing that consolidation pattern low, as we've seen drawn here in the chart. If I were more precise on my line, it's sitting right at the low. Now it challenged the low once, popped back through both the 250-day. Now it's challenging it again. If it moves, it's more likely to move up because you've got a little reverse head and shoulder pattern here. You've got down testing this lower line with two shoulder formations. So I'm guessing it's probably going to go up, especially with the economic data, but we'll have to see what happens. It doesn't mean it can't go down. It totally could, but it's consolidating. And silver's got a wider range because it's more volatile. I would look to see that silver, this pattern tightens a little bit more. You can see it tightening between 23 and 25 around that 2450 battleground slot that I always talk about. 2450 is so important in silver because it's a battleground. If it stays above 2450 and starts to run to 2627, you know it's probably headed to 30 at some point, and that's a little bit of a bullish sign. If it sits down here in 22 to 23 and then falls back to 20 or 18 bucks, then you could be in a bear market. Given the macroeconomic fundamentals, I don't think long-term that's where silver is going to go. But to illustrate the difference between silver and gold, more silver is used industrially. So if we're going to go into a recession, silver could fall more than gold because there's less demand overall for it before it pops back up. So that's typically when you go into a recession, you'll see silver fade a little bit more than gold. Gold will fade a little bit at the beginning of the recession, then it pops back up, and it'll lead silver back into that bull market as we get deeper into a recession. And I see those dynamics starting to form on the charts when you look basically 3 to 6 to 9 months. And so I think this is setting up for a bull market in both, but we could be in a short-term bear in the metals until that occurs. We'll have to see what happens in the economy. Again, the yield curve inversion is predicting recession. All the economic numbers that I've been reading to you for months are predicting a recession. Even a lot of the analysts at the banks are predicting a recession. All signs point to a recession. It's been 14, 15 years since we had a good one. The business cycle is pointing towards it. Corporate failures this year are pointing toward it. The banking issues are pointing toward it. Everything's pointing toward it, but we haven't had it yet. And so until we have it, you may see some fade in gold and silver. That's okay. That's normal. And in fact, when the recession first starts, people may sell a lot of these paper gold and silver ETFs and futures positions, which may drag down the price before we get that pop. So don't be surprised if that's what happens. All right, on the SilverCOT chart, which I have highlighted here, I wanted to show you what's going on. The swap dealers are basically, in essence, building up their short positions again. They do this over and over. They take the opposite position of everyone else. You see the swap dealers here have most of the red. That means they're reducing longs and taking more shorts and going short the metal, which is why it's fading. Everybody else is green, and all these other people are going to lose money. You notice the banks always make money. So when you follow what they do on the COT report, it tells you what's going to happen in the price over the same time frame. Now, this data is old. It's as of September 5th, because it's always printed behind or in arrears or whatever you want to say. But it basically means that they're building up short position again in silver and gold. And then as the price rises, they're going to get rid of that short position, take their money. And this is the same pattern. So again, when you see the COT report, we're in the same pattern of trades where they're basically just trading within a range to make a few pennies on every, or a few bucks on every contract. And they're going to continue to make money until that big move comes. And right now, I don't see that big move coming. All right, that's going to do it for what's going on in the market, both the gold and silver market, a little bit in the crypto market, a little bit what's going on with the economy, and further what I expect to see as we close out the year. My prediction is we're going to get full into the recession this year. Now, the government may not call it, because they always call it after the fact, because they want to look at what numbers are going down, and they want to play games with what numbers are actually going down, and then eventually they'll tell you what's happening. So we won't get the official call on the recession in the government probably until early next year, because you have to have two consecutive quarters of negative GDP, and now the administration doesn't want to call it unless you have declining labor, which, given their labor numbers are, let's say, massaged to the upside much of the time, it may cause them to call the recession much later this time than they've done in the past. However, I think we're likely to actually hit a real recession in the fall, and that's given the numbers. I think if you look at inflation and what it's done in the last year to people, most people feel as though they're in a recession right now, but the official government numbers will probably show an actual recession starting this year, probably by the latter half of the third quarter or beginning of the fourth quarter. And I'm in alignment with a lot of the banks and a lot of the financial houses that are predicting the same thing, because I'm looking at the same data they are. We'll have to see what actually happens. I think you'll have some fade in gold and silver. It'll range trade. You'll have some fade when that recession is first announced, as people dump their gold and silver paper positions to accumulate money to pay off bills and to go to safety. And then when people start demanding the physical, probably maybe 3 weeks, a month into that recession, you'll start to see a pop in the price. That's been the typical pattern. We'll see if it's going to follow that pattern again. All right, this has been your weekly market wrap at Gold Silver Pros, September 11th, 2023. Again, our thoughts and prayers go out to the families of those affected by September 11th, that date in our history, as well as those people that were part of resolving that issue, the emergency responders, and the people afterwards, the medical professionals, and everything that dealt with all of the effects of that. The psychologists and psychiatrists, which also had to deal with the emotional issues of that, and the families that have had to deal with the repercussions of that. Again, our hearts and prayers and our thoughts go out to those families that were affected by it by September 11th, all these years ago. Thank you guys so much for tuning in. Until next time, this is Rob Kientz with GoldSilverPros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.